Top three things. Number one, the euro. Number two, the yen. Actually, number one's the yen. I'm going to go with number two as the euro. But again, these are the two big currency moves. And then finally, we're going to go through the 10-year bond yield and what's going on in bond yields more specifically across the board in terms of both the U.S. and the globe abroad. But first, just hitting on the yen for what it is, they had the worst economic data point of the evening. Overnight, we basically had ISM services reported across the world. And again, Japan had the worst number, so pin the tail on the donkey there. 48.5 on the ISM services index. The number was north of 51 in the prior month. Japanese economic data, for those who've been watching the morning show for the last 3 days, has been horrific. And again, you want to buy horrific on that. So again, it's perverse, but it's true. On bad economic data, the yen burns and the Nikkei rises. So after last night's selling of Nikkeis, you want to be buying Nikkeis on the pullback, provided that you think that the yen is going lower. Point number two, euros are burning. Now again, you won't see this on Bloomberg's front page because Greece is not rising. On the 10% correction since February the 24th, not that we keep score, that the markets do, Greek stocks have gone straight down 10%, again, since February the 24th. And what you'll conveniently note is that mainstream media is not talking about it. Now, this, of course, does not cease to exist. The risk that is deflation to Greek debts and or any levered debtor out there during a period of global deflation remains paramount. So again, that's bad for the, let's call it the neighborhood that houses the euro. And again, if you house the euro and you're German and you keep the Greeks in your neighborhood, you will have a weaker euro. So again, we remain bearish on euros, bearish on yens, and bullish on dollars. If you're bullish on dollars and bearish on those other two for central planning reasons, you're also very bullish on the deflation theme. Again, being long deflation is being long the long bond, and it's having a 0% asset allocation to those things that are deflated, which includes commodities. Yesterday, commodity prices fell precipitously. If you're not just looking at oil and gold, by the way, these other things were still happening. Orange juice was down 7% on the day, Mortimer. And at the end of the day, you also had coffee down almost 7% on the day. And hogs, again, hogs, bacon, I don't know what eggs did yesterday, but hogs were down 2.5% on the day. They're down 18.7% for the year to date. Hogs, again, year to date, OJ, orange juice, down 17% for the year to date. The deflation, again, I'm not cherry picking. Coffee's down 24% for the year to date. So long Starbucks, short coffee. Your long consumption, you're bearish on deflation. Very good. Long, short, no perma nothing other than risk management. Finally, the 10-year bond yield, you want to be risk managing ahead of the jobs report, which is really all that matters for the 10-year bond yield from here in terms of the bigger, broader move. And the question remains, are jobs good or are they getting less good? It's about the rate of change. It's not being good or bad. It's getting better or worse. So again, the ADP number this morning has been getting worse really for 3 months. So don't forget that the jobless claims data series has started to get less good for 3 months. In our vernacular, going from great to good is bad. Did I say that? Going from great to good is bad. Going from bad to good is good. Could be great. These are rate of change terminologies. So again, looking at this for what it is, 10-year bond yield has immediate term downside on a bad jobs report to 1.88%. Immediate term trade resistance in the 10-year bond yield here in the U.S. is currently 2.17%. And those are your top three things.